Fair value gap is one concept that every ICT student must know by heart. What makes the fair value gap so central to ICT trading concepts is its versatility. It plays a role in almost every ICT model. But can it stand alone as a complete trading strategy by itself? Let's dive in and find out. First, what is a fair value gap? FVG. A fair value gap is a price action pattern formed by three consecutive candles, where the high or low of the first candle and the low or high of the third candle leave a gap within the body of the second candle. A fair value gap is created when price moves aggressively in one direction, signaling the presence of a strong trend. But what exactly do ICT traders use fair value gaps for? To answer that, we need to first understand ICT's core philosophy. Price only does two things. It either seeks liquidity, highs, lows, or returns to fair value gaps. With that in mind, ICT traders view fair value gaps as key price levels, zones that price is either targeting or likely to revisit, depending on the context. Because of this, fair value gaps are incredibly versatile. They can be used as take-profit targets. For example, when price takes out an old high and pulls back into the range, it often heads toward one of the fair value gaps left behind. They can serve as entry points, especially when traders are looking to enter on a lower time frame after a confirmation. They can also act as a tool to validate the strength and continuation of an ongoing trend. And those are just a few examples. This shows how deeply integrated fair value gaps are within the ICT trading framework. Let's walk through a real chart example to see how fair value gaps are used in ICT-based trading. Here we're looking at a XAUUSDH4 chart, and it's clear that the market is in a strong uptrend. As the price pushes upward, it leaves behind multiple fair value gaps, which we've marked on the chart. Notice how the price comes back to revisit some of these fair value gaps, likely to retest them before continuing the bullish move. Now let's zoom into a lower time frame to look for trade opportunities. On the M15 chart, we see the price pulling back into one of the H4 fair value gaps and reacting aggressively from it. As it moves up, it forms new fair value gaps and creating a market structure shift, a potential confirmation for a buy setup. One of the models we can use here is the breaker block entry. We place a buy limit at the highest point of the breaker block. Set your stop loss just below the candle that initiated the fair value gap. For the take profit, you can go for a 1-to-2 risk-to-reward ratio, a solid target in most setups. Now to the main question, is trading using only fair value gaps a viable strategy? Let's take it a step further. Should a fair value gap be the core of a trading strategy, even for students of ICT? My answer, no, it shouldn't. Don't get me wrong. Fair value gaps, FVGs, are an incredibly useful tool, especially when identifying opportunities in trend continuation setups. But should they be the central pillar of a trading strategy? Absolutely not. Why? Because fair value gaps alone don't provide enough context or information to form a complete strategy. Let's go back to one of our earlier examples. Price takes out an old high, leaves a fair value gap behind, and later starts to reverse seemingly to retest that zone, offering a sell setup. Seems like a strategy, right? Not quite. First off, calling that a full-fledged strategy is a stretch. Second, while it gives us a trading hypothesis, it doesn't tell us exactly when to enter, or even if we should enter at all. And that's the missing piece. So what do many ICT traders do at this point? They drop to a lower time frame and look for confirmation. Market structure shift, MSS, a supporting fair value gap, a breaker block at the point of reaction. Other forms of price action, confluence. And that is exactly my point. To build a real trading strategy, you need multiple layers of confirmation. Fair value gaps can play a key role for entries, take profits, even stop-loss placement, but they do not define it entirely. Fair value gaps are best used as confluence, a supporting tool within a broader, structured framework. That's how they shine, not as the star of the show, but as the piece that helps complete the picture. Let's take a look at another example of how ICT traders incorporate fair value gaps into their setups. Here we have a bearish trend. Price has taken an old low, creating multiple fair value gaps on the way down. Looking back now, of course, we know price eventually came back to the zone, specifically to the new fair value gap to retest it before continue with the downtrend. Question is, could we find a sell setup when it happened? Let's drop down to M15 chart for further analysis. Here we can see that price has created a market structure shift. Creating multiple fair value gaps too, and has taken a buy-side liquidity. For this setup, we can target the low below and open a sell limit order, entry at the newest fair value gap, with the RR of 1 to 2. If you found this video helpful,